Hello everyone, a huge welcome to you. We are so glad you decided to stop by and watch this video today.
Absolutely. It really means a lot. Great to be here.
And today we are tackling a giant. We're breaking down the Q4 and full year 2025 earnings call for Philip Morris International, or PMI.
Yeah, and this is a company that's trying to do something incredible. You called it a heart transplant while running a marathon.
It really feels like that, doesn't it?
Yeah.
They're making these huge headlines, pivoting away from cigarettes, and, well, based on this call, they are not looking back.
Not at all. The leadership team framed this whole thing around entering the second decade of their smoke-free journey.
And the word of the day was outstanding.
Right. They weren't shy about it, but, the numbers seem to back them up. Usually with these legacy companies, you hear transformation and you expect a lot of PR.
All fluff, yeah.
Exactly, but this felt different. The data suggests this isn't some side project anymore. It's rapidly becoming the whole business.
So before we jump into the Q&A, which was really lively, by the way, let's just unpack the presentation itself. What were the big headlines for 2025?
Well, the first thing that just jumps out is volume. In tobacco, you always hear about the melting ice cube, Volume shrinks, you raise prices.
Right.
But PMI broke that rule. 2025 was their fifth straight year of positive volume growth.
That's a huge deal. And I'm guessing that's not from more people smoking cigarettes.
No, not at all. It's all driven by this the structural shift to smoke-free products. The growth there is just staggering. Smoke-free volume was up 12.8%.
Okay, 12.8% on volume. What about the money side?
Even better. The organic smoke-free gross profit grew by 18.7%.
Wow, so almost a 20% jump in profit from the new stuff.
And it gets even more significant. Smoke-free products now make up about 43% of their total gross profit.
43%.
And in terms of revenue, it's almost $17 billion. That's 41.5% of their total. They're getting so close to that tipping point where they're really more of a smoke-free company.
That's a massive change for the company that built its entire empire on Marlboro. So let's talk products. The big three. First, IQOS, the heat-not-burn flagship. How's it doing?
Still the core driver. Shipments and what they call adjusted in-market sales both grew around 11%.
Okay.
And what's interesting is where that growth is coming from. Strong double-digit growth came back in Italy, which is a mature market, and they had a really promising start in Taiwan.
Okay, so IQOS is steady. Now, the one that's been all over the news in the U.S. is ZYN, nicotine pouches.
The juggernaut. I mean, despite supply constraints, and we know they've been struggling to make enough U.S. shipments, grew 37%.
37% growth while you can't even keep it on the shelves. That's just wild.
It really is. The growth is basically capped by their manufacturing. And internationally, it's also doing well. ZYN's share rose to 16%, excluding the Nordics.
And VEE, the e-vapor product.
That's the fastest growing brand now in international closed pods. Volume doubled, and they said it's profitable.
So all three engines are firing. But what about the old guard? Combustibles. Is Marlboro dead?
Far from it. They called it resilient. And honestly, it is. The performance was robust, mainly because they pushed pricing up by 7.6%.
So selling fewer, but for more money.
Exactly. And Marlboro itself actually hit a historic high for market share.
Wow.
They were very clear about the strategy. The cigarette business is the ATM. It's funding the whole smoke-free investment.
It's the fuel for the transition. Makes sense. Okay, financials. Bottom line for 2025.
Very healthy. Adjusted diluted EPS growth was 15%. That's their strongest since 2011 if you exclude the pandemic recovery.
And revenues.
Topped $40 billion. Operating margins are back over 40%.
Okay, and looking forward to 2026, what's the guidance?
They're forecasting organic net revenue growth of 5% to 7%. But they did flag some headwinds. There are some tax changes in Japan and tricky inventory comparisons for ZYN in the U.S.
Okay, so the ship is steady, but there are some waves coming. That actually sets us up perfectly for the Q&A. This is where analysts really try to figure out if 2026 is just a speed bump.
It's always the most revealing part, isn't it?
Let's dive in. First question, Matt Smith from Stifel. He was asking about their medium-term targets, specifically this idea of a reacceleration of smoke-free volume. He wanted to know why 2026 is slower.
Right. Matt was digging into the guidance, and Jacek Lutsak, the CEO, he took this one, and he introduced this really important concept he called asymmetry.
Asymmetry.
Yeah, he said 2026 is suffering from tax asymmetry in Japan. Japan's doing a multi-step excise tax hike. They're taxing heated tobacco first, and then cigarettes later in 2027.
Ah, so the cheaper alternative gets more expensive first. That's a tough sell for a year.
Exactly. It creates a temporary drag on growth. But he was confident that once symmetry returns in 2027, when the cigarette tax catches up, growth will resume.
Okay, and what about the U.S.?
He was really candid about another kind of asymmetry there, the product versus the demand. He called it portfolio gaps.
What does that mean exactly?
Well, in the U.S., consumers want higher nicotine strengths, moist pouches. Right now, ZYN in the U.S. is dry and lower strength. That's what was authorized by the FDA.
So they're selling one thing, but the market wants another.
Pretty much. They need the FDA to authorize ZYN Ultra and higher strengths to really compete. He thinks once that happens, it brings the portfolio into symmetry with demand, and that drives massive growth in 27 and beyond.
So 2026 is kind of a waiting game for the regulators.
In a way, yeah. He also pointed out some one-time tax hikes in India and Mexico on combustibles that are affecting 2026. But those aren't recurring.
Got it. Moving on. Next up was Eric Sirota from Morgan Stanley. He was focused on that smoke-free volume guide for 2026, high single digits to low teens, and he zoomed right back in on Japan.
Yeah, he wanted to know about the competition there since other companies are launching products.
Which is a huge question. Japan is their biggest IQOS market.
It is. So Jacek and the CFO, Emmanuel Babo, they tag-teamed this. They admitted, yeah, competition is up. But they said IQOS has held its share really well because they've spent a decade building that brand.
Brand loyalty. People don't just switch devices on a whim.
Right. And they are raising prices in April, which they know will impact volume, but they insist the underlying trend is still strong. But here is the key pivot.
Okay.
While Japan slows down a bit because of the tax, other markets are speeding up. They listed Italy, Germany, Spain, Romania.
And didn't they call out some brand new markets?
They did. Strong starts in Indonesia, the Philippines, and Taiwan specifically. They said they captured a 4% market share there in just a few weeks.
4% in a few weeks? That's insane adoption.
It's incredibly fast.
Eric also asked about IQS in the U.S., right?
He did, and the answer was interesting. They said their 2026 to 2028 growth plan does not rely heavily on IQOS Aluma launching in the U.S.
Oh, really?
It's in their investment plans, so they're spending money to get ready for it, but they aren't, banking on it to hit their numbers.
That feels smart. Manage expectations, especially with the FDA. If it happens, it's a bonus.
Very prudent, yeah.
Okay, next up was Bonnie Herzog from Goldman Sachs. She followed up on Japan, on the pricing. She wanted to know about price elasticity, like if prices go up, will people just quit?
Bonnie's always looking at the margins. Jadek and Emmanuel explained prices go up April 1st, and there are 2 tax steps. They expect some short-term volatility.
Sure.
But, and this was the key phrase, they said there is no rupture in the trend.
No rupture. Very clinical.
It means the long-term thesis is intact, the drivers are the same. A powerful smoke-free portfolio and that positive mix impact. Remember, smoke-free has higher margins now.
Right, so even if volume wobbles, the profit mix gets better.
Exactly. And for cigarettes, they still expect low single-digit revenue growth, even with volume drops in places like India and Mexico. The reason? Pricing power.
The classic tobacco playbook. Okay, next, Fambaig, UBS. He had a few questions. Innovation, ZYN promotions.
And currency. The innovation one was a bit cheeky. He pointed out IQOS Iluma is 5 years old and asked what's next.
And what'd they say?
Jurczyk kind of laughed it off. He confirmed the 5-year cycle, but said, for competitive reasons, he's not saying anything. Basically, nice try.
Fair enough. What about ZYN promotions? Phantom noticed they stopped running them.
Yeah, this is a big one for anyone watching the U.S. market. Jacek said pulling promos in Q4 was a deliberate choice, not a permanent shift. He laid out their marketing mix for growth.
Which is?
Brand equity, portfolio. He mentioned needing FDA approval for 6 milligrams and 9 milligram strengths again, and maintaining a price premium.
So they want to be the premium brand, not the discount option.
Precisely. The CFO then explained the better currency guidance was just because some big one-time losses from the Russian ruble and Swiss franc in 2025 won't repeat.
Got it. Less bad luck. Next was Gerald from Union Company. He asked about New York possibly hiking taxes on nicotine pouches.
And this is the big regulatory risk. Jacek was very direct. He called the proposal counterproductive to public health.
The argument being that ZYN is safer than cigarettes, so don't tax it like one.
Exactly. His logic is, if you tax the vastly better product too much, you remove the financial incentive for people to switch off cigarettes. But he did point out that just because New York does it doesn't mean every other state will follow.
A risk to watch, for sure. Finally, Damian McNeil from Deutsche Bank. He asked about their $2 billion cost savings target. And Of course.
He asked about AI. You can't escape the AI question on an earnings call in 2026.
So are they on track with the savings?
Emmanuel, the CFO, said they're firmly on track. About 60% of the savings are from cost of goods sold, the rest from back office G&A.
And the AI part.
He was a little cautious, call it a sensitive topic, probably didn't want to get into specifics. But he did confirm they see AI as a major engine for future efficiency.
So robots aren't taking over PMI just yet?
Not yet, but they're helping with the books. And there was a funny moment at the end.
Oh, yeah.
Jay Sheck, the CEO, actually corrected a number he'd misread earlier. He joked that his mistake was proof they were still human, not AI, and that he hadn't hallucinated the number, he just misread it.
I love that. I'm not hallucinating. I'm just human. Nice touch. Okay, let's wrap this up. What are the big themes we should be walking away with?
I think there are four main takeaways. First is the structural shift. This is not a drill. With 41.5% of revenue from smoke-free, PMI is becoming a different company.
It's the main event now, not a side project.
Not at all. Second is resilience. They're facing real headwinds, taxes, supply issues, but still projecting solid growth. That speaks to their pricing power and brands.
Okay, what's the third one?
The U.S. opportunity. I mean, ZYN is a monster, and it's basically doing this with one hand tied behind its back. If they get FDA approval for those higher-strength moist pouches, that's a massive catalyst just waiting.
The coiled spring in their valuation.
Absolutely. And finally, just financial health. Strong cash flow, they're paying down debt, raising the dividend. They seem really confident about their financial footing.
So it sounds like a company that knows where it's going, even if there are a few speed bumps in the road.
I think that's a fair assessment. They've got a very clear destination in mind.
Well, there you have it. A deep dive into Philip Morris International's 2025 performance. We really hope this breakdown helped you cut through some of the noise.
It was a pleasure unpacking it all.
And if you did find this helpful, please do us a huge favor. Click that like button, share the video, and definitely subscribe to the channel. We have a lot more of these coming your way.
Stay tuned.
Thanks again for watching, and we'll see you on the next one.